Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1289A, and today's date is May 25th, 2017, and the title of the episode is, The Setup is Almost Complete. Once the Fed does this, the collapse is imminent. Let's get into the economic collapse financial news. Now, as we've been looking at all the different economic sectors, talking about layoffs, talking about retail store closures, talking about low GDP numbers, how the unemployment numbers are completely fake. One thing we know for sure is that those people who are losing jobs, who've lost their high-paying jobs, receive part-time jobs, those students that graduate and can't find that full-time job, maybe they're living with their parents, maybe they have a part-time job, it's very difficult for many of us to survive day by day. And we can see by all these different surveys where people say, listen, I don't have $500 to pay for an emergency if something does come up that was completely unexpected. And we're seeing more and more of these surveys. And there's a new survey out there from Manulife Bank up in Canada. And it says that nearly 75% of Canadian homeowners would have difficulty paying their mortgages every month if their payments increased by as little as 10%. Now, many individuals, they do have the adjustable rate mortgages. Yes, we still have those. And they use those because they get a lower interest rate. And as the interest rates continually move up, this is going to be a problem because their mortgage payments could go up by 10%. And we're at very, very low interest rates right now, which makes it, bearable for many people. And the bank, what they did was they polled around 2,098 homeowners between the ages of 20 and 69 with household incomes between $50,000 or higher. And we can see that 14% of the respondents said they wouldn't be able to withstand any increase in their monthly payment, while 38% of those polled said they would withstand a payment hike of between 1 and 5% before having difficulty. And an additional 20% said they could stomach a hike of between 6 and 10% before feeling the pinch. When you add it all up, that means 72% of homeowners polled couldn't withstand a hike of 10% from their current record lows. And the CEO of Manulife Bank, Rick Looney, he says what these people don't realize is that we're at record low interest rates today. If mortgage rates increase by as little as 1 percentage point, some borrowers could be facing a hike of 10% on their monthly bills. And we can see that the Fed right now, well, they're raising rates. Eventually, other countries might follow along and raise rates, or rates might move up on their own. And we've seen this happen in the past, where then the central bank steps in and tries to control this. Now, Sears is out there, and we know they've been in a lot of trouble. We know JCPenney's, they've been in a lot of trouble. We see a lot of retail stores closing right now, around 3,500 just the first half of this year, projected out to be about 8,600 stores closing by the end of this year. And Sears, I see it all over the corporate media, that they had their first quarter profit in nearly 2 years, and this sent shares soaring by 20% or so. But when you look deeper into what they've done, there's a problem. Well, they sold their Craftsman brand. They sold it to Stanley Black & Decker in March for about $900 million. And this is going to be paid out over the next several years, including an upfront payment of around $525 million. Now, let's back out that sale, because when you back out that sale, well, Sears' losses deepened. The company said it would have reported a loss of $230 million. So the sales of their products, they're non-existent. They have a loss. And by selling parts of your business, this doesn't make you profitable. But of course, the corporate media is playing this up like everything is fantastic. And from this, it shows that Sears, well, most likely they're going to be completely out of business. Now, we understand that there's a lot of entitlements in the government. There's a lot of entitlement programs. And we see that there's different programs, and there's like 4 of the largest that are going on right now. And there's about 236 million that are dependent on these programs. And of course, these programs are Medicaid, Medicare, Social Security, and food stamps. Now, there are 74 million people on Medicaid. There's 58 million Americans on Medicare. There are 60 million Americans on Social Security. And I know that we pay into that, but the government borrowed that money. There's nothing left there, and they have to take out loans from the central bank to make this up. There's 44 million Americans on food stamps. Now, we're supposed to be in this incredible recovery, and before the recovery, there were only 26 million Americans on food stamps. Now there's 44 million people. But when you add all this up, there's a large portion of the country on these programs. And the country cannot support this anymore. It's completely impossible. And this is not even including all the smaller programs that are out there. And what is going to happen when the system falls apart? Just like when you have a business and it goes bankrupt, like Sears, for instance, where they're selling off bits and pieces of the business. Sales are declining all the time. Revenue is declining. Well, when the government goes belly up, all these things, all these programs are going to come to an end. And a lot of people are going to be angry. Remember, these programs, most of them that were put into place was to keep people quiet, because the system we're in today was never designed to help the everyday person. It wasn't designed to help you get a job, to help you live a comfortable life, to make sure that you can make a living, start a business easily. The system is designed against all of this. And this is why you see the wealth inequality. And they had to put these programs in place to cover up what the system is actually doing. It's one gigantic illusion. Actually, we're living in the Matrix. And when people start to wake up, well, just like in the movie with Neo, they're going to pop. And we can see right now that the pension programs, we have a pension crisis like no tomorrow. Nearly 600 state and local governments are now in the hole and has reached nearly 1.2 trillion of unfunded pension liabilities. And this reflects total pension liabilities of the 4.798 trillion and total pension assets of 3.6 trillion. This staggering number is nearly 25% of the annual GDP and accounts for roughly 97% of all public pension funds in the United States. So what we're looking at right now is a disaster on top of a disaster on top of a disaster. And we see more and more problems in the economy. Again, when we look at different sectors in the economy, we don't see, oh, this is doing well and this one's doing poorly. We see, okay, retail is doing poorly, GDP's poor, manufacturing doing poorly. We look at unemployment, completely manipulated. Unravel the manipulated numbers. What do we get? Unemployment, a complete disaster. And this goes on and on and on, housing and so forth. When we look at what is happening with trade deficits, well, it's not any better. The Census Bureau reports that international trade deficit in goods widened by 2.5 billion, 3.8%, with exports down and imports are up. This will subtract from the second quarter GDP estimates, which means it doesn't look too good. The economists, well, they expected the trade deficit to narrow to around 64.6 billion in a range of 65.5 billion to 62 billion. Not only did the economists miss the mark with the deficit larger than the biggest estimate, the Census Bureau revised the deficit for April higher from 64.8 billion to 65.1 billion. So the Fed's first quarter anomaly might be spreading to the second quarter now. Let's take this a little bit further. Retail and wholesale inventories in April, they dropped by 0.3% month on month, which, of course, they missed their expectations of 0.2%. And what this tells us is that the second quarter GDP, well, this is going to be revised even lower. And what we're seeing right now is things are being revised lower and lower and lower. They start at 4%, they go down to 3.5%, they go down to 3%, and they keep bringing it down and down and down further and further until you get to that 0.7%. And remember, this is the manipulated number. Now, we know that the stock market's manipulated. We know the bond market's manipulated. We know the unemployment numbers are manipulated. We know the GDP numbers are manipulated. We know the silver, the precious metals, the treasuries, the LIBOR, all that manipulated. Well, let's add one more thing. There were two researchers from the University of Texas. They were finance professors, and they looked at the VIX. And they said, wow, this is very odd. Something is going on with the VIX and the prices of the VIX, the deviations in the VIX prices. So John Griffin and Aman Shams of the University of Texas, who find a lot of trading in the S&P 500 options underlying the VIX during these settlement auctions, trading that pushes the settlement price of the VIX up or down, they found something very odd about this. So, for instance, in months where the trading pushes the VIX up, the prevailing price of the VIX influencing options will jump during the auction, and that peaks around 8:15 a.m. And then there's a drop seconds after the auction ends when the options start trading normally. And they go into this in their report, and we can see the VIX, well, it looks like this is rigged also. Actually, when we start to look at almost all of this, the entire market is one gigantic manipulation. And as we find out more information, it just gets worse and worse as time goes on. Now, back in February, we saw that in August, foreign official institutions, central banks, sovereign wealth funds, and reserve managers, well, they were liquidating U.S. Treasuries in record amounts, a process that only accelerated into year-end when official entities sold around $405 billion in U.S. paper in the LTM period. Now, the latest custody data from the Fed reveals in 2017, debt held at the Fed on behalf of foreign central banks has jumped by $61.2 billion to $2.922 trillion, the highest level since June of 2016. And we can see right now that the Fed, they are holding all of these treasuries. Now, we understand that the central bank, they've been controlling the economy, and they've been manipulating the economy with the help of the United States government, those individuals that are part of the deep state. And we're starting to see something very interesting where they have already started and triggered the collapse of the economy. Now, the Fed most likely has to do one more thing, and that is raise the interest rates one more time. Because we can see already with what they've already done, things are accelerating to the downside. And June is coming. Now, does it mean they're going to definitely do it in June? No, but we're going to watch this very carefully. Right now, the odds are very high that they're going to raise the interest rate in June. Now, the American public, they don't really look at the economy. I mean, the corporate media puts out things like, the unemployment numbers, the stock market, and pretty much it, and they tell you a lot of other information. And people take that information and they say, okay, the economy is doing very well. And that's pretty much what they do. I mean, there are individuals that look deep into it and they want to see what's going on. But many people, that's all they do. And the mainstream media, they tell them all of this information about like in a 30-second blurb telling you that everything is fine. They did this actually all the way up until 2008, until the stock market crashed. Now, we can see at this point that we've seen these patterns before where the Fed raises the interest rates and things start to fall apart. And we discussed this before. We saw it back in 2008 where they started to raise the rates. As soon as it triggered the entire system and it started to fall apart, they started dropping the rates. And this is why they are now raising the rates, because they are definitely triggering the economy to collapse. And we know something else that's very important, that central banks, including the Fed, they've been backing off on the stimulus measures. And they have now begun a series of interest rate hikes at the same time. So look at it this way. Imagine the economy has a terminal disease, and the only thing keeping it alive is drugs. And the free money is the drug. And they start taking that away. What happens? Well, things go south pretty darn fast. Everything crashes, just like a drug addict. You take away the drug, you go cold turkey, the drug addict crashes. And this is what the central banks are doing right now. So low interest rates and the Federal Reserve loans represent the purest form of the free money drug. When you take this away, everything crashes. Now, it looks like these marginal rate hikes, they don't seem like they mean anything. It's 0.25% here, then they raise it another 0.25, and it seems kind of meaningless. Like, oh, everyone says, what's the big deal? It's only 0.25. That's really not going to do anything. Now, it's only meaningless unless you are a corporation borrowing billions of dollars at a time so that you can stave off your exposure to quadrillions in derivative debt, and so that you can purchase massive shares in your own stock to keep its value artificially elevated. Any interest rate hikes in this environment will make borrowing from the Fed untenable for corporations seeking to prop up their stocks and the stock market. And we see them, and I say them, it's the Fed, continually raising the rates. Now, when they raise the rates and they trigger the economy, it normally takes around 6 to 8 months for the effects of the policy shifts by the Fed to become visible on Main Street. So when we look at this, and let's say we use the last interest rate hike, which was in January, we are then looking at what? February, March, April, May, June, July, August, September. If we're counting the one in June, and if they do raise it in June, well, then it looks like it's coming a little bit later this year. Now, this is just a gauge because this is what we've seen happen in the past. We're already seeing the economy fall apart very rapidly. And what's very interesting about this is they already started their campaign to blame Trump. Now, in the corporate media, every time the market drops, they say it's because of Trump's turmoil, because of Trump. It's Trump's market. And if it goes up, they call it Trump. If it comes down, they say it's Trump. This tells me that they are setting the narrative up. And they'll set it up now because they want everyone to get used to it. And as time goes on and the market falls, they'll be able to blame it on him. And this is what we're seeing right now. So the central bank, all they need to do is one more thing, and I think it's the next rate hike where we're going to see things really ramp up and accelerate. Now, they might not do it in June. They might wait July, August, but we'll have to wait to see. The percentages right now are very high that they're going to raise the rates in June. And what that means is you will most likely have maybe 6 to 8 months from that time period until everything falls apart. Now, this is just a gauge. It might go longer, might go shorter. We don't know. But from the past and from the history that we're looking at, we can see that this is a common theme because that's how long it takes to hit Main Street, the Main Street economy. So whatever you're doing, get prepared. Get your food, get your water. Make sure you have cash on hand. Make sure you have silver or gold or cryptocurrencies. Whatever you need to make sure that you have a lot of what you need out of the banking system. Make sure that you're prepared to hunker down in your home. Make sure you have food for your family. Make sure that you're ready to stay indoors. Pretend there's a storm coming and all the roads are blocked. You can't get out to the stores. How would you survive if this happens? And that's the way you have to look at it. So get prepared, get ready, because we're getting closer and closer. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.